Well, now that I have you here in the Cafe of Dreams, I was wondering if I could talk to you a little bit about the current financial situation, since this is truly your gift in the world. And today, we have experienced quite a bull market, quite an extended bull market from 2008. Here we are in 2014. And I was wondering if you could comment on your view of the current economic situation, especially in relationship to the debt level.
Okay.
The debt level that we're finding, not only government debt, international debt, corporate debt, personal debt,
Yeah.
perhaps margin debt.
Yes.
And whether you think that the situation can be rectified slowly, or do you see perhaps a danger of a bubble situation on the horizon?
Well, it's a very, very important and very intelligent question. Thank you. When I go back in the history of looking at these so-called explosions in the marketplace, and I don't want to identify what may happen next to precisely what's happened in the past, but you need to be aware of it. I've been through market crashes that occurred in 1964, 1987, the year 2000. I call them crashes because when markets come down, they come down much faster than when they go up,
That's right.
as we all know. And so you've got to be prepared for them. What I have been advising clientele of the firm and of our financial advisors here is that clients should have anywhere from 15 to 30% of their accounts in cash, because we could likely have some event that occurred similar to the year 2000. I'm not predicting that will happen immediately, but all the elements are there in certain aspects of the market's place. The market had a good sell-off here 3-4 weeks ago, and it went down, and then it behaved just like a V, the letter V, and it's come back up and passed on to new highs.
That's right.
And today again, we're on to new high ground. And there are certain elements of the market that are really selling at huge price-earnings ratios. One of them, the example, is our restaurants, which is just shocking. Chipotle is an example of that, and maybe Chipotle should sell at unusual price to earnings, 50 times earnings. But it seems to me that the technology in restaurants is a lot less accomplished than the technology in real technology. So we've got the internet securities, we've got the restaurant stocks, we actually have furniture, building securities are all selling at extraordinary prices, in my opinion. Mm-hmm. And yet at the same time, on the other side, we have an extraordinary amount of cash in clients' accounts, not only here at our firm, but many other firms as well. So there's been a good cash reserve built up, which means the ability to buy securities is still out there, and it's very, 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 very strong. So I look at the balance between where we are and what's still out there that's favorable, and at the same time, my concern about how long this will continue to go, and the fact that we could have another downswing is abruptly. So what I would do is I would segregate between securities I feel comfortable owning and at the same time have cash reserves. You mentioned before margin. There is not today an overuse of margin,
Okay.
margin debt. It's because of all the cash reserves. However, the other debts that you mentioned are really important. The U.S. government debt, the world debt problems, the individual debt problems. Interestingly, a company like Apple, which doesn't need to raise any money and to issue any debt, just a few weeks ago issued debt in another country and to raise money. Why did they do that? Because the interest rates are so low and so artificially low
Yes.
that they can get money almost for free. And so here companies that don't need to have debt, or they're not the only one, that are taking on debt so that they can get money in their hands when the interest rates are really fantastically low. So I'm concerned about that kind of behavior. I believe that corporate debt is much more extraordinary than it needs to be. Mm-hmm. But again, because of the cash out there and the earnings that are in these companies, we seem to be in a reasonably favorable condition. So we're in a balance. Mm-hmm. And that's not new to me, of course, and we're in a balance, but again, the risk of some kind of a sharp decline is more so now than it has been for 3 or 4 years.